There is a number that changes how a bank looks at you. You do not see it happen. Your app looks the same, your debit card still works, your balance displays normally, no red banner appears, no one calls you, no cheerful relationship manager says a word. But if you are sitting on $20,000 or anything close to it in a plain checking or savings account, you may already be living under a very different set of practical rules than the ones most depositors think govern their money. That is where I want to begin, because the misunderstanding here is not small. Most people think a bank account is a storage box with a debit card attached. You put money in, the bank keeps it safe, you use it when you need it. End of story. That is not really what the relationship is. It feels that way in normal times because normal times hide the legal structure. The agreement sits quietly in the background while nothing unusual happens. You get paid, you pay bills, you transfer money. Everything behaves politely enough that you never have any reason to think about the pages you signed when you open the account. That is exactly why so few people ever read them. And I do not blame them. Those documents are not written to be read in the ordinary sense. They are written to satisfy disclosure, protect the institution, and bury the most consequential rights inside language. Almost no ordinary customer will ever revisit until a problem forces them to. That is the real issue. The most important clauses in a bank account agreement do not live on page 1 beside the glossy promises about convenience, mobile deposit, and customer support. They live in the middle. In the dry sections, in the paragraphs that begin with phrases like subject to applicable law and notwithstanding the foregoing, that is where the power lives. The source makes another important point I agree with. The $20,000 figure is not some magical number written cleanly into a federal statute, as if Congress stood up one day and announced that banks may now begin treating depositors differently at exactly that threshold. That is not how it works. The number matters because of profitability. That is the language to understand. A bank holding $20,000 in a savings account is paying something on that money. The exact number changes with rates, but the principle does not. If it is paying you interest, then to make money on the relationship, it has to put your money to work somewhere else at a higher return. Mortgages, auto loans, credit cards, business loans, investments. That is how the spread is created. Now, think about what kind of customer the bank loves. A customer with deposits and debt, a mortgage, a card balance, a car loan, a line of credit, maybe fees, maybe investments. The institution can earn in many places. Now think about the customer the source is describing, $20,000 sitting there. No mortgage with the bank, no card balance carrying interest, no loan, no line of credit, no profitable entanglement. That customer is what the banking system internally understands as a deposit, only relationship. That is a terrible customer profitability terms. You are expensive to carry and harder to monetize. That does not mean the bank hates you emotionally. It means the agreement you signed becomes more important because the bank needs tools to manage a relationship that is less valuable to it than you probably imagine. And those tools are already in the contract. The first one is the right of offset. This is the clause that should make everyone slow down. In plain English, it means that if you owe money to the same institution where you hold your deposits, the bank may take money from your deposit account and apply it toward that debt without warning you first. In the moment it happens, that sentence carries more weight than most people realize, because most depositors still imagine debt collection in a very theatrical way. Missed payments, letters, calls, threats, negotiation, time to respond. The right of offset bypasses a great deal of that. If the same institution both holds your cash and owns your debt, then under the agreement it may be able to move money from one side to the other first and explain later. What matters even more is the part ordinary people would never guess. The source says the clause often applies whether or not the obligation is currently due. That language matters enormously. It means the bank's power is not limited to a debt already in obvious default. It can reach across the relationship much earlier than the average customer imagines. A credit card balance, a loan, a disputed amount, a current obligation. The bank may not need to wait for the exact dramatic moment the customer thinks would make such an action fair. That is the legal point. And the emotional point is even sharper. Most people still think their savings account is their protected side of the house, their safe room, their independent reserve. Then something happens and they discover the wall between savings and debt inside the same institution was never as solid as they believed. The source describes a former escalated customer service worker who dealt with these calls often enough that they were practically routine. That detail matters to me, not because one anecdote proves everything, but because routine categories of customer confusion tell you where the mental model is wrong. If enough customers are shocked by the same mechanism, then the real problem is not their surprise alone. The real problem is the gap between what they think the relationship is and what the contract actually permits. That is the first clause. The second is less dramatic at first glance, but in practical terms it may be even more frustrating. Funds availability holds. People think deposited money becomes usable money the moment it appears in the account balance. That is not always true. This is one of those areas where the law sets minimum standards, but the account agreement often gives the institution more room under specific conditions than the ordinary customer has ever bothered to imagine. The source points out that a large incoming deposit into an account already holding a substantial balance can trigger extended holds. In plain English, the money appears, the total balance looks larger. The customer breathes easier because on the screen the deposit seems to have landed, but the funds are not truly available. They are visible. Yes, they are yours in the broad sense. Yes, they are simply not usable when you need them. That distinction can matter tremendously. Imagine believing you have the cash to close on something, to pay an urgent bill, to move money quickly in a stressed moment, to solve a problem that cannot wait. Then discovering the balance is mostly decorative for the next several business days. This is what I mean when I say the legal structure and the lived experience only collide under pressure. In ordinary life, a hold is an annoyance. In a stressful moment, it becomes a revelation. The money was there. It just was not accessible. That is the second lesson. Ownership and access are not always the same thing inside the banking system. Now we come to the third clause, and this one matters because of the return mechanism, account termination. Most people vaguely understand that a bank can close an account relationship if it chooses to. They do not tend to think through what happens next. That is where the real issue begins. When a bank closes your account, the common customer fantasy is that the money will somehow be transferred back neatly, instantly, electronically, as though the institution that just decided it no longer wants the relationship will also prioritize your convenience in the exit. That is not how it works. The source says the usual mechanism is a mailed paper check, not a same. Minute wire, not an elegant instant transfer. A check that matters because the moment that check is cut and mailed, you have entered another timeline. The money is legally yours. Yes, but now it is in transit, then it must arrive. Then you have to deposit it somewhere else. Then the new institution can apply its own availability policy. So a balance that was supposedly yours all along can become practically inaccessible for days or even longer during the exact moment you are least prepared for friction. That is a serious point. People talk about liquidity as if it were a permanent feature of cash. But bank liquidity for the customer is partly a function of relationship, timing, process, and permission. Cash in the abstract is liquid. Cash inside an account governed by clauses you have never read is only as frictionless as the institution allows it to be under the conditions that actually show up. That is a very different way of thinking about my money. Now let us get to the fourth clause, because this is the one that changes the whole emotional tone of the discussion: deposit reclassification. This is not the clause that feels most alarming in a cinematic sense. It is more subtle than that. It is more institutional. And because it is more institutional, I think it carries even more weight. The source describes a practice documented in Federal Reserve examination materials for years. Overnight, while the customer saw nothing unusual, deposit balances could be moved internally between categories in ways that affected the bank's reserve calculations without changing what the customer saw in the app the next morning. That is the point: to understand the visible experience of the depositor did not change, the legal and accounting treatment behind the scenes did. That means the ordinary customer was not wrong to think the money was still there. It was there in the ordinary conversational sense. But the actual system in which that money lived had already been operating on it in ways the depositor never saw, never approved in that moment, and likely never even imagined. This is where I think the source becomes strongest. It stops asking whether the money is yours in the simplistic emotional sense and starts asking what the bank is allowed to do around that money inside the legal architecture of the relationship. That is a much smarter question, because once you see that the bank can offset, hold, terminate, and internally classify according to permissions buried inside the agreement, the account stops looking like a pure service box and starts looking like what it really is. A permission structure, that phrase matters a lot to me. People think they signed up for a service. Convenience, storage, access statements, cards, apps, those are the visible features. But beneath those features is a permission system that governs what the institution may do when the relationship becomes inconvenient, stressed, disputed, or simply less attractive to maintain. That is the real contract, not the smiling marketing page. The buried permissions. And I want to say something carefully here. This is not a call for hysteria. I am not saying every bank is waiting maliciously to pounce on depositors the moment they cross $20,000. That is not how serious analysis works. Institutions do not need villainy to create problems. They only need incentives, legal permissions, and a customer base that rarely reads the documents binding it. That is enough. The source asks the most intelligent question in the whole piece near the end. What is the appropriate amount of cash to keep at a single institution? That is the right question, because it moves the issue from fear into structure. I do not think there is one universal number for everybody. There cannot be. The right answer depends on whether you also owe the institution money, how quickly you may need access, whether the cash is being built or spent, whether you are drawing income from it, whether the account is one of several or your only buffer, whether you are close to major payments, major transitions, or periods of uncertainty. But the absence of one perfect number does not erase the lesson. Concentration of cash inside one relationship deserves more thought than most people have given it, especially if debt lives on the other side of the same institution, especially if the money is meant to be emergency liquidity, especially if you are holding it there simply because that is where it has always been. Habit is not structure. Now let me tell you what I think is the deepest danger here. Not the clauses themselves, not even the individual mechanics. The deepest danger is the mental model. If you believe your account agreement is basically a polite service brochure with a few legal decorations attached, you will make one set of decisions if you understand that it is a document granting the institution a series of rights over timing, access, offset, termination, and internal treatment. You will make another. That difference in mental model changes behavior. You diversify institutions, you separate deposits from debts, you think harder about emergency funds, you read the actual clauses, you ask better questions before you need the answers. That is the real value here. Not panic precision. The source ends in exactly the right place. Go read the agreement, not the first page, not the summary. The actual sections on set-off or offset, the sections on hold periods, the sections on account closure and return of funds. Those clauses are not waiting for a crisis to become relevant. They became relevant the day you signed them. The only question is whether you discover that before the bank ever needs to use them. That is why I would rather know now. And if I am holding meaningful cash, I would rather think like an owner of risk than a customer of convenience, because convenience is what the bank sells you. Permission is what the contract gives itself. That is the line most people never notice until after it matters.